All right, welcome back. Today, we're jumping into our essential annual update, taking a really deep look at the world of fixed income for 2026. You know, the rules of the game have seriously changed, and if your portfolio hasn't kept up, you could be falling behind and not even know it. So let's break down exactly what's different, and more importantly, what you can actually do about it. And this, right here, is the core idea we're going to unpack today. That simple, almost automatic strategy that worked for generations, well, it went through a near-death experience a few years ago. And it's come back. It comes with a new set of rules. Rules that are pretty much non-negotiable for anyone who wants to protect their wealth. And they involve looking way beyond just stocks and bonds to things like gold and other commodities. So here's the game plan. We'll start by figuring out what exactly went wrong with the classic 60/40. Then we'll learn how to read the two most important signals the market is sending us for 2026. After that, we'll build a modern portfolio designed for resilience. And finally, I'll give you a brand new, actionable playbook for how to invest in bonds right now. For, 50, 60 years, the 60/40 portfolio was the absolute bedrock of investing. I mean, it was simple, it was reliable, and it was just the default answer for millions of people. But recent history has shown some major cracks in that foundation, and it's forcing all of us to question what we thought was a sure thing. You know, the whole idea, which investing legend Benjamin Graham really pushed, is just beautifully simple. You put 60% of your money in stocks, and that's your engine for growth. The other 40% goes into high-quality bonds, and that was supposed to be the brakes, a steady stream of income and your safety net for when the stock market inevitably got a little crazy. And the whole thing worked because of one key relationship. They were supposed to move in opposite directions. So when investors got scared, what do? They sold their stocks and piled into the safety of government bonds. This flood of money would push bond prices up just as stock prices were falling. The bond part of your portfolio would zag when the stock part zigged. It was a perfect little seesaw that smoothed out the ride. But then 2022 happened. Inflation, which was basically asleep for a decade, just roared back to life. And in response, central banks started hiking interest rates like crazy. Well, that turned out to be a toxic cocktail for the 60/40. Rising rates absolutely crushed the price of existing bonds. And at the same time, it terrified the stock market. So for the first time in decades, both sides of the portfolio, the stocks and the bonds, went down hard together. The safety net just wasn't there. Now, sure, 2025 saw a comeback because those high rates made bonds look juicy again. But the lesson was learned. The old model is not foolproof anymore. It absolutely has to evolve. Okay, so if we're going to build a better portfolio, we first need to get a handle on the economic weather report. And luckily, there are two key signals, two charts really, that tell you almost everything you need to know about what the market is thinking right now. First up is the yield curve. Now, I know, it sounds super complicated, but it's really not. All it is a simple graph that shows you the interest rate you get for lending money to the government for different amounts of time, everything from a month all the way out to 30 years. And the shape of that curve is an incredibly powerful clue about the health of the economy. See, in a normal, healthy economy, the curve slopes up. You demand a higher interest rate for locking up your money for 30 years than you would for just 3 months. That makes perfect sense, right? More time, more risk, you want more reward. But every now and then the curve flips upside down. It inverts. That's when short-term rates are suddenly higher than long-term rates. This is the market basically screaming that it's worried about the near future and expects a recession, forcing the central bank to cut rates down the road. It is one of the most reliable recession warnings we've ever found. The second signal is even more direct. It just compares stocks to bonds. We can do this with something called the earnings yield on stocks. Just think of it as the flip side of the PE ratio. And look at this comparison right now. If the stock market is offering you a yield of about 2.7%, but you can get a guaranteed 4.5% from a risk-free treasury bond, well, the decision gets a lot tougher. It forces you to ask a really important question. Are you actually getting paid enough to take on the extra risk of owning stocks? And this quote just nails the relationship perfectly. Think about it like this. That 10-year treasury yield, that's your risk-free alternative. It's like the financial world's force of gravity. And when that rate goes up, when gravity gets stronger, it pulls down on the value of everything else, especially stocks, because suddenly that guaranteed safe option looks a whole lot better. Which, of course, brings us to the biggest question of all. We know the old 60/40 is shaky. We know the signals from the market are complex. So where do we go from here? How in the world do we build something that can actually handle whatever the economy decides to throw at us?
Well, the answer seems to be in true diversification. And I don't just mean a mix of stocks and bonds. I mean diversifying across assets that do well in totally different kinds of economic climates. This is the whole idea behind what's called the all-weather or all-seasons portfolio. This was pioneered by the legendary investor Ray Dalio, and it's designed to be balanced, but not by asset class. It's balanced by economic risk. You'll notice it's actually heavier on bonds than stocks. But the absolute game changer, the crucial addition, is that 15% split between gold and commodities. These are the exact assets that a classic 60/40 portfolio completely ignores.
So here's the thinking behind it. Dalio basically says there are 4 economic seasons. You can have rising growth, falling growth, rising inflation, or falling inflation. The goal is just to own something that does well in each of those seasons. Stocks, they love economic growth. Bonds, they love it when both growth and inflation are falling. And here's the key. Gold and commodities, real tangible assets, they tend to be the only things that do well when inflation is surprisingly high. You know, the exact environment that killed the 60/40 back in 2022.
And the proof is really in the pudding here. Just look at the brutal 2008 financial crisis. The S&P 500 lost over 37%. The worst one-year loss for this strategy was less than 4%. I mean, just let that sink in for a second. This portfolio isn't about hitting home runs. It's about preserving your capital and creating a smooth, steady ride with very few big drops, which for most of us is the real secret to staying invested for the long haul. Okay, now, even with a solid framework like this all-weather portfolio, how you manage the bond part of it is absolutely critical. To really win in 2026, you've got to be a smarter bond investor. The days of just buying a bond fund and calling it a day, those are pretty much over. So here's the first thing you absolutely have to get. A bond really has 2 different yields. First, there's the coupon. That's the fixed interest rate that's literally printed on the bond. It never, ever changes. But the number that really matters to you is the yield to maturity, or YTM. That's your actual total return per year if you hold it to the end. It accounts for all the coupon payments and, crucially, the price you paid for the bond. Let's look at this example because it makes it really clear. We have a standard $1,000 bond with a 5% coupon. If you pay a premium for it, say $198, your actual yield, your YTM, drops to 4%. Why? Well, because you're guaranteed to lose that extra $98 when the bond matures and you only get your $1,000 back. But look at the flip side. If you can buy that same bond at a discount for $800, your YTM skyrockets to 7.2%. You still get those 5% coupon payments, plus you lock in a guaranteed $200 profit at the end. This is where the real opportunity is.
So how do you actually manage this in a world where interest rates are always moving? Well, one of the smartest and most effective strategies is called bond laddering. The idea is, instead of dumping all your money into one 10-year bond, you build a ladder to spread out the risk and create a predictable stream of cash. And it's a pretty simple 3-step process. First, you just pick your time frame. Let's say 5 years. Second, you split your cash into 5 equal piles. You buy a 1-year bond, a 2-year bond, a 3-year, a 4-year, and a 5-year. Then, here's the magic. As that 1-year bond matures, you take the cash and you buy a new 5-year bond. You do this every single year. This gives you steady income, and it makes sure you're never totally locked into one interest rate. You're always able to take advantage of new, maybe higher, rates. It's a fantastic way to automate your strategy. But here is the brutal truth about timing any of this. Most people, they wait. They wait until the big news headlines say, the Federal Reserve has done hiking rates. The problem is, the market is a forward-looking machine. By the time it's on the front page, the pros have already bought in. The real money, the capital gains, are made by buying bonds before rates actually fall, when their prices are still low. When rates do fall, those bond prices go up, and you get a nice profit on top of your yield. If you wait for the all-clear signal, you've probably already missed the best part of the move. So let's just quickly recap the playbook for 2026. First, you've got to accept that the classic 60/40 portfolio needs an upgrade for this new world. Second, learn to read the yield curve. It's like your economic GPS. Third, remember that real diversification means bringing in things like gold and commodities to protect you from inflation. And finally, you have to be proactive. Understand what YTM is and use strategies like laddering to actually manage your bonds instead of just letting them sit there. So we'll end on this one question. The strategies that worked so well for the last 10 years, they were powered by falling interest rates and super low inflation. That era is over. The next decade is probably going to look very, very different. And the most important question you can ask yourself right now is your portfolio built for that new reality? Thanks for tuning in.